Um, and Malcolm is based in Sydney, and I am based here in Perth in my home office. And the purpose of today is to talk you through one of our asset managers, which is Joseph Palmer and Sons, and to introduce you to Malcolm. We have various clients who are looking at the markets at the moment, and we are looking for ways to manage and navigate the way that things are at the moment. So without further ado, I'd like to introduce Malcolm. Malcolm is the managing partner of Joseph Palmer and Sons, and is the grandson of the firm's founder. Forgive me, I'm new to the technology, so I'm just trying to get our slides all up and running. Before I introduce Malcolm, I just want to confirm that the information in this webinar is of a general nature, and that we encourage you to seek financial advice before acting on any of the information that we provide to you today. Just a short and brief introduction about me. I'm a certified financial planner, and I have been working with clients for over 30 years in the financial services industry. And then, as I've mentioned earlier, over to Malcolm. So Malcolm is the managing partner of Joseph Palmer and Sons. It's Australia's oldest family-owned stockbroking and funds management organisation. Malcolm was elected a member of the Australian Stock Exchange in 1993. Joseph Palmer and Sons operates as an investment manager for some of your business and wealth clients. As part of this role, Malcolm provides economic and investment perspectives to his investment advisors and their clients. Prior to joining the family firm, Malcolm was investment director at Tyndall Investment Management. Malcolm's extensive experience in investment analysis led him to develop proprietary investment analytical systems at Joseph Palmer and Sons. These systems are used in the management of equity, property, and fixed interest funds for clients and financial advisors. Malcolm has been a lecturer at numerous Australian Stock Exchange investor education courses and conducts regular presentation on investments, economics, and related topics, and is a member of the Stockbrokers Association of Australia. I'm going to stop sharing my screen for you, Malcolm, so that you can share yours, and it's over to you, and welcome, and thank you for joining us and having a chat to our clients today.
Thank you, Norma, and good afternoon or good morning, afternoon in Sydney and morning in Western Australia to everybody. It's my pleasure. I suspect that I've spoken to some of you before through my seminars I've done in Perth, and for those that I have, nice to hear or see you again through this digital age, and otherwise nice to meet you in the first instance. I might just do a quick check that, Norma, can you see my screen okay? Is the sharing of my screen working?
Yes, Malcolm, I can see you, and I can see the international markets and world interest rate screen that you are sharing.
Fantastic. Well, let's get going without any further ado then. So what I'd like to do today is try and cover off on some of the important questions and situations. And I think we all know that the news at the moment, economically and market-wise, is not good. And we're not going to sugarcoat that today. We're going to go through as much information as I can that I think we'll find of some relevance and use and interest to you to try and navigate our way through with some intelligence in the market conditions that we find ourselves in, somewhat surprisingly with what's gone on. So I'm going to cover a few things, and first of all, please take note that I can't present something without giving opinions and ideas, and just remember what Norman said about being a disclaimer that I'm not giving you personal financial advice. So if I mention a particular stock or something that I like, please go and have a word to Norman before you do anything about it. So let's start with a talk about dislocation of markets and volatility in stock markets, and also a little bit of information about what's going on in terms of the ups and downs we're seeing and whether or not it's going to continue for a while or not. So this little first picture I've got here is a picture of it's called the VIX index, and believe it or not, in this day and age of sort of electronic everything, the stock markets and the currency markets and the foreign exchange and commodity markets all have a sub-indice called the volatility index, and it's quite complex, but it's based on the premiums that exist within the options markets. Nevertheless, it's just a gauge, and this is a gauge that shows you it's sort of bookended, if you like, from 2008 with the GFC and now, and we've got very similar rises in volatility And volatility means extreme movements of prices. And that's what we've got at the moment. I just want to give you that sort of pictorial position to start with, how after a long period of relatively calm marketplaces, we've hit a really significant volatility spot that will last for a few months, I imagine, before it starts to ease. The other way of gauging this is just an interesting position that I observed the other day that Morningstar produced in America. This is just the daily movements on the stock market. And this only goes back the last year, but you can see the daily movements are generally pretty mild until all of a sudden it was volatile, and you had these big swings up and down as the market sort of became dislocated from the real pricing. And what do I mean by dislocated? And I'm talking about stock markets here to start with. I'm going to get onto some economic things and whatever in a sec. But starting with the stock market pricing dislocation is that nobody quite knows, and not me nor Norman or anybody really in the world knows what the forward economic position is going to be given the extent of the pandemic and the economic disaster that's occurring and unfolding around the world. And so when markets don't quite know how to price themselves, you see this volatility emerge as there's an attempt, if you like, because remember that asset prices, no matter what they happen to be, particularly stock prices, are simply the representation of the net position between the buyer and the seller. So there's buyers of stocks, there's sellers of stocks, and the net position between the, if you like, the psychology of the two represents the price on a day. Overlaying that in this day and age, and not just recently, but for the last 30 or 40 years, you've had the advent of computer trading. So you get very significant, if you like, amplification of movement caused by the algorithms. And algorithms are, in terms of the mathematical algorithms that drive markets, are now responsible for more than 80%, that's 80% of all stock market trades are generated by the computer itself as opposed to the human. And so consequently, you have lots of turnover happening in markets during a time of significant volatility, and you have this amplification effect taking place. I'm going to try and show you just briefly what I mean by that. And this is a quick snapshot, and I don't know whether you can see this clearly in the flickering away, but this just happens to be the live market for Commonwealth Bank. It could be any share. And all of the little trading that's going through at the moment, all this changing of volumes and prices, is the computer trades are buying and selling tiny parcels of shares, 18 shares, 40 shares, 90 shares, 10 shares. It's not human beings putting in a price order for 10 shares and 20 shares and 50 shares. These are things like exchange traded funds and the algorithm that runs off them dictating price movements. I just wanted to show you this as a live example because even in a relatively calm day like today, you've still got very rapid turnover. And since I've started talking to you, there's been probably 20 or 30 or maybe 50 transactions just in Commonwealth Bank by this ticking away of the algorithm. Thought might be useful exercise just to show you how markets are driving themselves and how the effect of things takes place quite quickly. So that's one observation, and the observation, of course, has to do with the very significant disruption that's happening, and this is causing this large price movement that's going on across the marketplace. So it will end, of course, and if we have a look at that previous time, the volatility spike that happened in 2008 took a while to get back to sort of average levels, like it took a year or so or more, with still relatively higher than above trend volatility. And I think we can expect that going forward as we go through this period of very significant economic uncertainty. And if you think about the phases of investing that we're going through at the moment, and the phase started abruptly, didn't it? So, the stock markets of the world, and those of you who heard me when I was last in Perth talk about how I was concerned about the 2020 outlook because of a whole range of things about the US election, about overpriced shares, about there being the potential disruption, if you like, on the bond market coming from too much printed money and quantitative easing, these sorts of things. But nowhere in there you'll recollect I had anything about a pandemic. So a pandemic, of course, has caused there to be an immediate disruption of a significant degree, which has reset everything, all thinking on investment for the future. The first phase of the disaster, if you like, is this huge volatility spike, which I'm illustrating. The second phase is the setting in, if you like, of the economic reality of the time. And I'm not going into, though I'm not underplaying, but I'm not going into the virus itself or the health consequences. I think we all know and have read and have our own understanding of that particular thing. My job today is to talk about the economic and market consequences and how we can intelligently invest during such times. So volatility is with us for a while, and don't be too spooked by it, because so much of it's driven by short-term amplification through electronic trading as opposed to the reality of business valuation. So let's turn now to a few other observations. This again comes out of the United States, but it's the same all around the world. And these red numbers here just show the different types of shares that have been affected more than others, or in some instances less than others. And you can see defensive shares have gone down by far less than sensitive shares. Sensitive shares meaning, you know, companies in the energy industry and so on. And those that are economically cyclical have also fallen a bit. So the defensive sectors like utilities and healthcare have performed quite well on a relative basis. And I guess that's understood because defensive companies have got less economic cyclicality and hence less difficulty in predicting their forward earnings. And on that point, in terms of difficulty of predicting forward earnings, I've been doing this job for a long time now, and I don't recollect a time where my gazing forward into the future is as difficult as it is now in terms of gauging what company profits and economic statistics and dividends might be in the forthcoming year or two. It's as difficult as even projecting into the bank shares. So you think about Westpac and ANZ and National Bank and Macquarie, not Commonwealth at this stage, but those four banks happen to be March 31 balance date companies. So they're just about to report their profits for the 6 months to 31st of March. And when I say just about, we're talking about next week and the week after. And so these companies are going to be the first big companies, this is ANZ, Westpac, NAB and Macquarie, the first big companies to report to the stock market since this crisis began. So they'll represent a really important market test case as to whether or not big business is finding their way through this at all yet, or whether the uncertainties are still so great that they can't even give us much guidance. There'll be large cuts in dividends coming from those banks and large falls in their earnings, partly to do with their provisioning, because if you think about what they're going to report 5 good months and 1 bad month. So really the numbers themselves are going to be quite good, but the provisioning they're going to make for the future is going to be quite bad. So they sit within these sort of financial services sector and not within the defensive sector of markets, which have performed much better. So now just turn to some economic stuff. And at the moment, the only actual economic data that's come out of proper reading is some of the Chinese numbers. The US numbers are coming through, the Australian numbers are coming through. We tend to be a little slow in producing our quarterly economic data, and most of the data for the March quarter will come out in May. Most of it will be irrelevant by then because we would have gone through a period of this sort of March and April slowdown. But these Chinese numbers have come out a couple of days ago, and you can see significant declines in all areas. Industrial production's down by 20% or so, retail sales have fallen from +10 to -10. Fixed asset investment, and PMI. PMI stands for the Purchasers Managers Index, and it's a good forward indicator because it represents what the managers within businesses, if you like, are placing as forward orders. So it's a forward-looking economic indicator, and when it falls precipitously like it has, then it's obviously a bad economic sign. The PMI is based on 50, an index of 50. And whenever it goes below 50, it's a bad signal, like it did during the financial crisis. And whether it goes a little bit above it, it means it's above trend economic activity. But none of this is news to anybody. You just need to look down in the streets to see that the activity is completely dried up, and there's been a significant, if you like, disruption of the global supply chain. And when the global supply chain is disrupted, everything follows. So this is the sort of information we're going to be seeing. And I observe this not because we don't know it's already factual, but because markets will bump up against this type of news bit by bit as the next year or so progresses, and it won't ease in a hurry. The March quarter and June quarter numbers will be particularly bad, and then there'll be positive numbers again. But the actual underlying economic downturn data won't ease very quickly. And we just need to be ready for that as we go into a recession, which is now certain. Looking at some other information, this was in The Economist this morning. I'm a pretty boring person. I tend to spend my time reading The Economist and other such things. And this came out in their overnight edition. And this has got just the most recent International Monetary Fund economic predictions for the different countries. Just sort of interesting in a sense, because first of all, the rich countries like us and America, whatever, their forecasts now a very significant decline in this year. in economic activity. We'll talk about GDP here. And a reasonably strong rebound in 2021. But interestingly, the emerging countries, including China, according to the IMF, the decline is far less significant and the rebound is greater. So there's sort of a bit of an indicator in here of maybe a bit of a shift in the balance of power economically in the world, still continuing. And perhaps this will be an acceleration of that shift. Maybe that's got something to do with the, if you like, the geopolitical bantering that's now going on between China and America in terms of their sort of superpower status. And that's a topic that could have a webinar in itself, talking geopolitics between China and America. So interesting observation, very sharp declines in the Western world, including here, and we need to be ready for this type of, perhaps as much as 10% GDP decline for a quarter. And certainly the headlines that represent the statistical evidence of there being a recession, but meaning there are two successive quarters of negative GDP growth. So that's something, and again, I'm not sugarcoating things, I'm telling you things how they are, and then trying to work out how we invest during such a time as we go forward through this discussion today. So looking now at our government's position, this is just simply an indication of the Australian government's balance sheet relative to other countries, because lots is being said about the stimulus provided, and I'm going to talk now about a bit of the stimulus provided as well. For the government sector, the public sector, to take control of the economic situation and to do what they can to, not eradicate, but to create the upside and the recovery phase that we're going to have. And Australia's got about 20% in the federal government of its of debt to GDP. So it's a very, very low number by world standards. And if you recollect, after the Howard and Costello years, the Australian government debt was down to zero. So this is the sort of the debt that Australia's been borrowing for the last decade or so, and most of it's come in the last few years. In the last year or two, in particular, we've been borrowing around about $1 billion a week, and consequently, the debt's now up to 20% of GDP, which is very, very low. So we've got, thankfully, as a country, we've got lots of government capacity when interest rates are really low to borrow a lot of money to help the economy. We're yet again the lucky country in this regard, because if you're in Europe or America or elsewhere, you're already somewhat strained on your balance sheet. So it's less easy for those countries to create debt or borrow money to sort this problem out. And they have to go through the more unconventional policy of money printing. And we're doing that as well, by the way. So for the first time in Australia's history, there's so much stuff, I have to say, that's happening for the first time in our history. And Norma introduced me, and thank you for doing so, as an organisation, or the representative of an organisation that started the stock exchange in Australia. So we have a long history of going through the cycles. I've got all the economic data going back 150 years or whatever. And so there's lots of stuff now that we haven't seen before. We haven't seen negative interest rates in Australia before, which we're getting. We haven't seen, like we saw overnight, a negative oil price. So I'll get to that in a sec. And of course, we haven't seen Australia ever print money to stimulate economics. We've seen monetary policy used, that is raising and lowering interest rates, but to go to the printing press and to produce money out of thin air is something which we haven't done for really forever as an emergency step, not even during the Great Depression. So the status is that we have lots of capacity to borrow, and the federal government is now embarked on a $200 to $300 billion borrowing binge, if we can call it that, to provide for the stimulus to help the economy see its way through this very sharp downturn. And the way they're doing that is a couple of ways, and I'm going to talk about the economic ways as opposed to necessarily the job keeper, job seeker things. So one of the economic things they're doing is they're providing a thing called a term funding facility, and a term funding facility is for the Reserve Bank, which is the head of the banking system in the country, the provider of liquidity. The Reserve Bank is now providing to the banks, so we're talking about all the big banks and all the small banks, pretty much as much money as they want at 0.25%. So it sort of has to be said again to understand the enormity of this. The banks can now get as much money as they want for 1/4%. So basically for free, as much as they want to lend to their customers, so long as they've got customers who are able to borrow. And for every customer, the banks will lend, for every customer of a bank that is a small business, and a small business definition is less than $50 million turnover, so small and medium businesses, For every dollar that a bank under this term funding facility will lend to a small and medium business, the Reserve Bank will provide them with another 5. So they're exaggerating the stimulus to small businesses in an extraordinary way. And so as we go forward the next year or so, a lot of this cheap money will flow into the economy that's produced by the Reserve Bank, and they're produced by winding up the printing press and creating this massive amount of liquidity. So we'll see where that comes about, but it can't be a bad thing for the economy for the next year or two. And it can't be a bad thing for 2 reasons. First of all, it's good for the banks because the banks have got cheap funding. And if the banks have got cheap funding, it takes the pressure off bank balance sheets and allows them to actually expand what they call their net interest margin. And the second thing, of course, it provides cheap liquidity to society. And consequently, there is more money available at a very low rate for businesses that need money to be able to get through this troubled time. So it's going to be a good outcome. Now, there'll be a question about, yes, it's good short term, and of course that's the case. So all of this concept of, it's called, around the world, this process of printing money is called, they call it quantitative easing. And they call it quantitative easing because nobody quite knows what quantitative easing means. And if you call it quantitative easing, then the media doesn't understand it. And consequently, people don't realise that it's actually just printing money. And if you just said, oh, we're going to print money, then the public doesn't like that. If you call it quantitative easing, well, we don't know what they're talking about. So quantitative easing or printing money is now going to, around the world, because it's been happening for a long time in other countries, is going to create a very significant future problem because it becomes inflationary down the track, because you're diluting, by having more money in circulation, the pricing power of each dollar. And sooner or later, the pricing power dilution causes inflation, and that will come about eventually. Though for the time being, it's not inflationary because the forces of disinflation are very strong. The force of disinflation is globalization and automation, keeping prices down. And now keeping prices down is a consumption slump. So consequently, that's why we see the oil price down, the petrol price down. And I don't know what it is in Perth, but my local petrol station is selling unleaded petrol at 89 cents a litre at the moment, which, who'd have guessed that a year or two ago? So that's the sort of thing that's going on in terms of consumption. And so because there's no inflation, the central banks of the world, and Australia included, says, well, we can print some money and borrow some money now without there being any great strain on either inflation or on the cost of repayment because the interest rate is so low. It's all about kicking the can down the road. And so the next generation of Australians are going to have to pay for this, just like the next generation of Americans and Europeans and Japanese will pay for their, I won't call it folly because it's necessary, but it'll have to pay for the extravagance, if you like, of the central bank actions. So that brings me then to interest rates, because interest rates are a key consideration with all of this. And I've just sort of popped up here a whole lot of different interest rates because I just want to illustrate that everything's zero. Like every one of these charts and every interest rate you look at in any country of the world of any substance is zero. And interest rates have gone down to this extraordinary position and will probably stay there for a long period of time. Interest rates in whatever country you see, whether the European Union, which is currently negative interest rates, or Japan, which is slightly negative, or America, which is zero, or Australia, which is close to zero. It's the same thing everywhere that interest rates are down around about the lowest you can imaginably expect them to be. And that opens up a couple of discussion points as well. One, of course, is for people who have investment monies are going to receive pretty much no interest for some time now. You'll recollect I mentioned the concept of the term funding facility initiated by the Reserve Bank. Well, the term funding facility is a 3-year plan on the 3-year government bond to hold the 3-year bond at 0.25%. And so when you look at the funding facility they put into place, the position with it is that, I'll just show you that, if I may. So the Australian 3-year government bond is this is the Reserve Bank's actions in the last few weeks to bring the interest rate down from, was around about 0.8 down to 0.25%. This is the 3-year bond. So this is money there, if you like, borrowing for 3 years, not for 3 days or 3 months, but 3 years. So it's not the cash rate. So on the first Tuesday every month, the Reserve Bank meets and they make a pronouncement on the cash rate, interest rates. And that interest rate, the short-term interest rate, which they pronounce every month, is 0.25. But now they've made a secondary pronouncement, that being that the 3-year interest rate, which is this one, is also going to be 0.25. So how can you manufacture a 3-year interest rate at 0.25? The only way to do it is to buy it and to keep buying and to buy it and to buy it and to buy it. So the Reserve Bank is doing that. They're spending billions. They've spent more than $20 billion already of freshly minted Australian dollars to go and buy in the money market from the banks 3-year bonds to hold the interest rate at nothing, or 0.25, to produce liquidity in the system. So all sorts of emergency actions are going on here. And interest rates, whether they be overnight or 3 years, are now at 0.25%. And that's not going to change for some time. The Reserve Bank has indicated that these interest rates, or this program, is going to continue. Obviously, if they're buying a 3-year bond, they're thinking 3 years. Now, it might not come to pass that it's 3 years. With any luck, the crisis will be over well before then. But nevertheless, that's their objective at the moment, is to create very, very cheap liquidity for a 3-year period and perhaps beyond. So that's sort of interest rates in terms of an observation of things and where they stand. If you look sort of elsewhere in terms of commodities now, so this is another area which I just wanted to make a couple of mentions about. And so I have here on the screen 3 commodities. I have gold, which has stayed very stable and gone up a little bit. And the reason why gold is going up is because it is the flip side of what I said about the dilutionary impact of printing money. So if you have a dollar, a US dollar or an Aussie dollar or a yen or a euro, and the authorities, being the central bank, the Reserve Bank here, or the Federal Reserve in America, or the European Central Bank, just keeps printing the stuff, then the tangible value of each dollar is slowly diminished. Whereas gold, or any form of fixed asset, and some would say fixed assets go all the way down to things like bricks and mortar here as well. So fixed assets are going to retain their value a little bit better than a dilutionary asset that's being diluted by the authorities. So gold has held its own during this crisis, had a little bit of a blip, but it's held its own. Copper, which is more of an industrial metal used in telecommunications, which had far less of a slowdown than, say, oil, which has collapsed. And oil, of course, is heavily economically sensitive. And there's lots of things that come out of this situation with oil. One of them, of course, is that there is a disinflationary impact of lower petrol prices and lower input costs into things like petrochemicals and plastics and so on. And that's a good thing for economics, because businesses, we cover, for example, Amcor. Amcor is a share that we own, and Amcor is a business that is in packaging, and it needs raw materials to make packaging. And the raw material costs have gone down considerably because the petrochemical input costs have gone down. So it's actually a benefit for a business like that this has happened. On the flip side of all of that, though, it's waylaid. I have no doubt about this at all. It's waylaid what was a accelerating transition towards renewable energy. So this pandemic is going to have all sorts of consequences and all sorts of left field things, and we'll talk about them as the next couple of years progress. But one of the left field things, regrettably, is there's going to be a slowdown in the shift towards renewable energy, simply because it's cheaper to do it through oil now. Fossil fuels have become much, much, much cheaper to produce energy, and the economic necessity, if you like, or the economic pressure more than necessity on business is so strong or so great now that they'll prefer to go to the lowest common denominator of price, which is now back to fossil fuels. So these are some of the things. So I spend a fair bit of my time trying to join the dots, not just looking at what's happening today or yesterday, but saying, well, what are the consequences of those events for other things down the track, be they economic or commodities or geopolitical or for the stock market or whatever. And these are some of the things which I'm observing at the moment, some of the anti-inflationary events, some of the growth events and so on. Last night, this is news, you would have probably seen this in the overnight news, but the oil price went negative, and for the first time in history. And it's an anomaly, so please don't think this is anything other than an anomaly. but it's an anomaly because of the futures market expiring today. So what happens with the futures market? Every month there's a contract and people buy or sell. So of course the people who provide energy to the futures market are the producers, the Exxons and Woodsides and so on. And the buyers are the industry and the aviation companies and the refineries and so on to buy the energy. And at the moment, there is no oil required because the aeroplanes are parked and the cars are parked, and the strategic reserves in countries, that is the big tanks that sit around the ports, are full already. So there is no demand at the end of this particular contract for oil, the May contract, which expires a month, which is tonight in America. So in the last day of trading, it just evaporated, which is this sign here. But the actual market for oil is about 20-something US dollars a barrel still. So I just thought that was an interesting observation. Again, an anomaly, like an extraordinary market event that one would never have dreamt this could have happened. That first of all, the price of oil would have gone from $60 to $20. And secondly, that there would be a dislocation of the contract, the futures contract, that caused that particular contract to go below zero. So in other words, people who owned that contract and had to close it out on the last day had to give their all away for nothing. And you know, again, but it's a bit like negative interest rates, isn't it? We've got quite a lot of deposits of our clients. So we own quite a lot of shares overseas for our clients, and we've got money in yen and euros and other currencies and some of the European currencies like Danish krona. And those bank accounts that we're holding our clients' monies in now in those other countries are now not paying us any interest, and not just not paying any interest to our clients, but also taking interest away. So for the right to have money on a deposit in yen or euros, or Swiss francs in particular, the bank will take some of your money as an interest payment as opposed to an interest charge as opposed to interest payment. It's so bizarre I can barely even explain it. So that's just another element in terms of the weird world we're living in that's been, again, amplified by this crisis that we're going through. So in terms of a bit of discussion now about stock markets, which is probably relevant, a fair bit relevant to our discussion today. Now, what do we do? What's happening with the markets? Are they going to go back up? Are they going to stay down for a while? And I guess there's a bit of a general observation with this to start with, is that when recessions take place, and regrettably they do from time to time, investing needs to be done with a cautious eye over your shoulder, if I can put it that way. Just be careful. I'm encouraging people to be careful. It doesn't mean you don't invest or you don't believe there to be a good future investment, because there really is. It's just a matter of being circumspect, not spending all your money at once, buying the dips, and making sure that one doesn't go beyond one's particular risk profile. So let me talk through a few things around that topic. So this is the stock markets of the world. These yellow lines up the top, this is America and Japan, and these are in Australian dollars. So you can see how those two markets haven't done so badly. And that's pretty good. I have to say it's a little surprising that the US stock market's held up so well. But part of that's got to do with some of the behemoths over there. So we're talking about Amazon. Amazon's hit a record high price yesterday, record all-time high price. So, for a company like that, which is one of their biggest companies, or one of the biggest companies in the world, if not the biggest now, is to hit a record high price. It's of course going to help their stock markets. And the US dollar's been generally strong, and so too is the Japanese yen, which has helped Australian dollar investors there. So what do we do in the market? And I just sort of put these thought bubbles out there, and I'll just try and talk through a couple of these things. So first of all, be tactically astute. What does that mean? Tactically astute, well, of course we want to do that, and it's a bit of a motherhood, isn't it? But tactically astute means there's going to be more volatility in the stock market. There just will be. You can't go through an economic uncertainty phase like we're having without there being lots of ups and downs in share prices and asset prices over the next little while. And that will be manifest in all sorts of ways, and there's lots of ways we can illustrate that. The stock market itself, for example, has got a volatility pattern to it that's coming and going, and so we had this big sharp fall off in the stock market, a bit of a bounce. Maybe it's falling again now for a little while, and as we go forward the next little while, there'll be these ups and downs. So you want to try and make sure that we're tactically astute, so we don't get sucked into panicking when the market goes through these terrible sell-offs, or getting believing that the trouble's all over when it has a bit of a rally. So a little bit of investing for over a period of time. I had just a young guy, a son of a friend of mine, who rang me up yesterday, first time in the stock market, just a young man, And he said, you know, what do I do? I've got $5,000 to invest. I said, well, get that $5,000 invested over the next 6 months, but not today. You know, buy $1,000 every month and we'll find some good stocks. That type of investing is something I'm encouraging to be tactically sensible about, if that was a comment worth making. So that's one element. The second element of this deliberation is, you know, make sure your investment portfolio has got all the cash you need for the next 2 years, even longer if you have a heavy pension draw. So just keep that money on the side. The last thing you want to do during a recession is to be forced to sell a share when prices are low because you have to pay out a pension payment or to pay for something that you already know you're going to need. So, you know, there's an Irish guy called Murphy. He'll come along at that particular point in time that you need to sell, and Murphy's Law will prevail. So you're better off having that money parked on the side. And I know Norma will give you that advice to do so, and I suspect that many of you do already. But during a recession, that becomes even more important to make sure you've got your capital. It doesn't have to be in cash. It can be in a term deposit or some other fixed income or bonds or something. But those monies need to be kept aside. The next thing is to expect and to plan for very significant declines in income in portfolios. And this is regrettable, and it's going to be a consequence of this crisis, that companies are now being, particularly companies that are being the recipient of government handouts, are going to feel an obligation, and not just an obligation to government, obligation to all their stakeholders, to withhold their capital, both for balance sheet repair and for future growth potential, and not pay it out as a distributable income. And so there's going to be a big drop away for a shortish period of time, but not just 1.5 year, but for 1.5 years or so. So a very hard decline in dividend payouts for this half year. Now we're talking about the half year that for companies that have March balance dates and companies that have June balance dates. And then by December or September and December, there may be an easing of that downtrend in dividends. But by this time next year, or even late next year, the dividends won't be back to anywhere near what they were last year. So we just need to put that into our thinking, that as we project cash flow into our portfolios from shares, these distributions will be quite a lot lower. And I've spent a bit of time today talking about interest rates, haven't I? And interest rates are nothing. So money you do have parked on the side is going to earn you nothing. And consequently, the overall portfolio return is going to be hamstrung by both distributions being lower on shares and interest rates being low. It can't be helped. And I can't emphasize enough the necessity to not go and up-risk a portfolio just because interest rates are low. You only up-risk a portfolio, buy a lot of shares, for example, is if it suits your risk profile, not because interest rates are low. So that's another element I just want to point out. So hold large cash positions are normal. And I'm asking people, or suggesting to people, that they be prepared to be fully invested to your risk profile by the end of the downturn. Now, of course, that's easy to say and hard to do, because when's the end of the downturn? But we are projecting that this downturn will last a fair while, and not just a few months, okay? So we're going probably into next year. So sometime between now and sometime during 2021, if you have an investment portfolio that has a long-term plan to have, 70% in the stock market or 30% in the stock market, whatever it is that's the right position for you, then you should achieve that position and not be underinvested at the end of the cycle. Because the best time, it's the psychology of investing, and it's one of the things I've trained myself to do for a long, long time, is when things are really crook, like really crook, you got to think buy. And when things are really euphoric, you turn it all around and think sell. And so one of the things about the stock market, or any asset price, real estate as well, and any type of tradable asset, is that optimism becomes greed and pessimism becomes fear. So when you have these spikes from optimism to greed, it's a sell time. And when you have these spikes from pessimism to fear, it's a buy time. And you just need to put that sort of reverse psychology to your thinking, which is why I'm already encouraging people early in the downturn to think about being fully invested by the end of the downturn. And if you do that and you get yourself fully invested, you don't wait for it to go back up again before you buy the shares, then it will become a strategy that works for most people better than others. And then the last thing I say, and don't panic, because the reason for that is this is the stock market for the last 50 years or so, the last 40 years. And, it's a pretty good place to invest. So even with these sharp downturns that happen from time to time, the GFC, the one we've got now, this is the crash back in 1987, if anybody remembers that, I remember it. And so the stock market in Australia with dividends is a pretty good place to invest. And if you think of it slightly differently, over the last 40 years, the stock market's gone down only 11 times. However, we're just about to have the 12th. And so you can see in the decade just gone, there were only 2 down years. In the 2000 and 2010 decade, there were 2 down years. And normally there's 3 or 4 down years, so out of 10. So it's going to happen. We're going to have a down year, an up year, and a down year, and an up year. And in the end, you'll get 7 or so up years for every down year in the stock market, and for every 3 down years in the stock market. And consequently, people should remember that the stock market is actually a very good place to invest, and sort of always is in terms of the forward outlook of things. So I wanted to give you that observation. Value on the stock market, how do you work it out? Not easy at the moment. I run an economic and stock market model, which we call relative value analysis, and I've used the same modelling now for more than 30 years, and it works okay. In fact, it works very well, but it doesn't tell you what tomorrow brings. It just tells you what the long-term position brings. So the long-term position now in the stock market is that the fair value position is about 6,000 points, and we're currently 5,300. So the stock market's about 12% underpriced, but this is a long-term projection. It's not tomorrow. So when we compare the stock market 12% plus our dividends, you see the dividend yield of 3% here. It's much lower. So I've cut dividends across the market. I've cut, Westpac's dividend from $1.80 to $1.20. I've cut Commonwealth Bank down to $3.50. Cut Woodside in half and maybe more. So these companies are going to have much lower dividends and possibly 0 dividend for a half-year period, and then a bigger dividend at the end of the year, for example. So dividends are lower. But the stock market's offering a 15% potential return now for when things ease, and so consequently there's quite a lot of risk-adjusted return. But because the uncertainty is so great, I don't quite believe these numbers at the moment, because the numbers I'm putting into the economic spreadsheet are so uncertain that, if you like, there needs to be a greater margin for error built into your investment thinking, which is some of the points I've made today. So what are we doing? What's around? What are we buying in shares? What are we thinking about? So first of all, if you have just a share portfolio, keep 20% in cash, okay? At least 20% in cash, park it on the side. In terms of shares you've got, we like BHP. BHP is largely unaffected, as is Rio and Fortescue. Iron ore demand is pretty good. I showed you very early on in this presentation the expected through the IMF pickup in China relative to other countries, and that industrial demand should add something to the commodity markets that other sectors of the economy don't have. I don't expect the commodity markets to be entirely without downside risk, mind you, but perhaps a little less than, say, in tourism and whatnot. We own Link shares. There's an interesting article today about them. They own a business called PEXA, which is the electronic property exchange. So property now is going to be transacted as residential property like the stock market, and you trade electronically or settle electronically, which this sort of lockdown period is now amplifying that electronic settlement environment, and that's what Link's in. And, gas companies, AGL's fine, Amcor I mentioned. Banks like Macquarie is good. Got lots of healthcare shares, Sonic Healthcare, CSL, Invocare, which is funeral home, so not really healthcare. It's after healthcare has failed. Ramsay Healthcare. So these are good shares. Things we've just bought recently, 2 new stock we've been buying, though we aren't buying just at the moment because they've gone up a bit. First is Ansell. Ansell is Australia's biggest, or one of the world's biggest manufacturer of hospital gloves for surgeons and for cleaning and for industrial and so on, so protective equipment. And it's not just that demand for their product that appeals to us, it's the lower input costs for the manufacture of the product, as I explained about the oil price. And we've been buying Sydney Airport, though they've gone back up to $6. So it's one of those tactical things I referred to, be tactically astute with your investing. You buy Sydney Airport at $5, it's pretty good, but $6, not so good. And people would say, well, that's crazy buying Sydney Airport when it's essentially closed. And the reason it's Sydney Airport is because no other airport in Australia is listed on the stock market. It's the only one. But the reason is that it's an infrastructure asset with 77 years of life left in its concession. So if you have 1 year out of its next 77 unavailable because it's closed, then you take 1/77th off the net present value. That's a bit silly because nobody prices a net present value over 77 years. So you take 1/15th off it or something like that, and you get a share price that's certainly lower, but not quite as low as it went. So there are, a few shares, and then in amongst these, it's important to focus on balance sheet strength. So there's a few companies that have got more sort of economic gearing risks than others, but they're also sometimes more opportunistic. And companies like Boral, for example, are way down. It's a company involved in cement and aggregates and fly ash as well. Fly ash is the gunk you take out of the chimneys of power stations to produce cement. So that industry is clearly cyclical and they're way down, and their balance sheet's a little bit strained. So that might be a company that goes cap in hand to shareholders, which we're seeing all over the place. Companies are going and saying, well, let's take advantage, let's plan for the downturn by shoring up our balance sheet by raising some extra capital. And so they have. And Boral might do that. Invocare's already done it. Other companies have done it. So many of them. Cochlear has, and Bapcor has, and Shopping Centres Australasia has, and Oil Search, and on we go. So there'll be lots of this opportunity. If you own shares in some of these companies, then there might be a discount on offer for new shares. When I say might, it's not always the case, but there might be, and it's a good opportunity to have a think about these if these offers turn up. Don't throw out the paperwork if it comes in the post if you own shares for these offers without giving it some proper consideration. There's a couple of bargains out there. Cochlear, for example, is doing a raising at $140, and the shares have been about 180, 190, so it's quite a steep discount and worth participating in. Turning overseas, so overseas we've got even more cash. We own, encouraging people to have 30% of their money in cash. And when I say 30%, this is 30% of the share money. You'd have other cash as well. This is just not buying shares with money that you would normally buy shares. So being really quite defensive with the investing. But in amongst here, there's just some cracking good companies around the world, particularly in healthcare. I mean, Roche, a Swiss company in healthcare, their share price is almost at a record high. Well, it is in Australian dollars. Novo Nordisk, a big Danish company in diabetes treatments. Sanofi is a French company. They're involved in pharmaceuticals as well. So those healthcare companies have gone really well. And then the tech companies, Amazon and Alphabet, which is Google, and Tencent, which is a phenomenal business. It's also gone up during this crisis. I mean, you can't imagine why it shouldn't. Tencent, it's the biggest in the world business. It's the biggest Asian company in the world, listed on the Hong Kong Stock Exchange. What it does, it provides the social media, the SMS messaging, the mobile phone-based games for Asian people, and of course they've got hundreds and hundreds of millions of customers sitting at home using their devices. So it's been a bit of a phenomenon. So they're the sorts of shares we're having overseas. Just a bit more careful, and the reason being, before somebody asked a question about why so much cash, is because it's very hard now to take an Australian dollar at 63 cents to the US and think it's a good deal to exchange into a US dollar. It's just not good value is the bottom line, even though some of the companies are pretty good value. So we're just being, again, even more careful with the international investing because of that in mind. So there's a bit of a summary of what we're up to with share portfolios. And I'm going to sort of now pass back to Norma and ask for any questions. I think there's a portal facility for you to type some questions in or have them run through Norma, and she can pass them through to me. And whatever they happen to be, even if it's not related to the stock market, I'm very, very happy to have a go at answering them for you. So thanks for your attention, and I appreciate the opportunity to speak to the HERE customers and to the HERE people.
Thank you, Malcolm. And thank you to everyone that has joined us this morning. So Malcolm, what I'm going to do is I'm just going to share some of the questions that we have received this morning. So one of those questions is assuming that, I quote, assuming that the share market is crook and the risk profile is right for you, is it time to leverage into shares?
No, is my answer to that. I'm always, and always have been, completely anti-leverage into shares. Not because I don't get it, that it works from time to time, but I think that leverage into real estate, where you have a stable asset price, is the correct way of leveraging as opposed to leveraging into shares.
Right. So I'm just checking whether there's anybody else that has any other questions for Malcolm at this point.
If they don't, I'll just try and share something with you, Norma, if I can.
No problem.
I don't know whether you can see this, but I'm going to hold it up on the screen because there's a bit of tech going silly. But I have here my Great Depression 1932 file from my office, right? So And I've gone back to that. So this is the period from 1929 to 1932. I just thought I'd read what my grandfather was saying back in 1930. And I'll just read to you, because it's sort of interesting how stock markets sort of repeat themselves in terms of the psychology of investing. So I'm quoting here from the 18th of December 1930. We have to report an average turnover for the month. Prices as a whole are somewhat lower than a month ago, but standard lines of stock are a good deal above the ridiculously low point of a few weeks previously. As the new Commonwealth loans, think about Reserve Bank action now, as the new Commonwealth loans must have affected the demand for existing stocks, the market has held very well. And this, taken in conjunction with the widespread response to the new loans, is evidence that money for investment is not so scarce as many people imagined. This is at the depth of the depression, okay, talking about a recovery happening in the stock market. The market usually gathers strength after the middle of November. This is like late 1930. And this year has been no exception. Of course, it remains to be seen whether, as in normal times, there is an improvement during the first quarter of the new year. But as the very safest securities are procurable at far below intrinsic value, we have no hesitation in recommending them to clients. Now, we could put that out today, in all these years later, that comment. Of course, it remains to be there, but as the very safest securities are procurable at far below intrinsic values, we have no hesitation in recommending them to our clients. So that's the sort of thing that I just find it interesting to observe the psychology of investing, and that's the psychology that was prevailing during the Great Depression. And from that point forward, markets were pretty strong for a while.
Okay. All right. So thank you, Malcolm. So another question is, what other options could we look at other than cash that is only slightly riskier but higher yielding?
So a lot of people like the industry subclass called hybrids, and bank hybrids, for example. And if I can just show you one or two of them. So if you have a security called, say you take the WP Westpac. Oops, let me get the right one. So this is a security from Westpac that matures at the end of 2021, so the end of next year, at $100, and it was trading comfortably at $104 because these pay interest rates. They pay distributions that are franked, and the distribution rate is around about 3% plus some franking, so it grosses up to just over 4% if you can use the franking credits. And these are popular, but they're not without risk. And if you can see on this chart here, the $104 evaporated to $92 in a blink of an eye back in when the crisis hit. Now it's back up to $100 again. So this is the type of price movement, or if you like, the amplification of risk in these types of investments that can happen. So the trade-off always with any form of investment, no matter what you do and whenever you do it, is that you're seeking a higher rate of return, which this is offering, then you have a commensurately higher rate of risk. And sometimes you cop the risk, and you have to cop it when it happens. So if you paid $106 for them, like they were last September, and they were $92, then all of the interest rate you've got for several years has been wiped out in a couple of days. And that's what happens with these securities. So yes, they're popular. It's obviously better to buy them below $100, below their face value, their maturity value. And it's obviously better to understand the risk characteristics before you buy them. But this is an asset class that's got some merit for, with the right portfolio, with the right advice and with the right security. And it's an option for the person who was asking about some income from other types of investing.
All right. So an interesting question, negative interest rates, what are the real issues?
Well, the thing that causes negative interest rates, firstly, is a phenomenon itself, because what happens is that the central banks can manufacture interest rates down, and then the market forces take over. So people who buy bonds, and I'll just illustrate on the screen here. So these are the interest rates around the world. So all the ones that are in red are negative interest rate. Oh, sorry, I apologise. Negative interest rate in France for 5 years. Negative interest rate in Japan for 5 years. In France for 5 years. Okay, so these interest rates are in Germany for 10 years. these interest rates are negative, and the thing that caused them to go negative is the supply put out by the central bank, and the central bank is turning around and buying them. So in other words, the same institution that's issuing the bond is turning around and buying the bond to deliberately manufacture a negative interest rate or low interest rate. So then you get the real market participant. And if you think about anything that's involved in insurance, so if you're an insurance business, so you have any of the Australian insurance companies or any of the world insurance companies, think Germany, think Allianz, they have to match their future liabilities by holding bonds. They can't own shares to match future liabilities. So what an insurance company does is that they take on a policy, and the risk of the policy is calculated by the actuary, and then they put that money aside, the premium they're charging for the insurance policy, invested in bonds, even with a negative interest rate, because they know the capital's secure, because it's government debt, so that when the claim comes, actuarially, statistically in the future, they've got the money held, even if it doesn't make any interest, to pay out those claims. And they're competing with the central banks buying bonds, and consequently they're, if you like, leapfrogging each other to own the bond because they have to own them. They have no choice. And you end up with these negative interest rates. It's a sort of phenomenon that's, you know, I have to say can't end well, right? Because somewhere down the track, this whole phenomenon of monetary systems, and I went through this in the seminar, I gave it here back in, I think in November. We talked at length about the monetary systems of the world and the probability that there's going to be an end game to all of this, and perhaps a huge dislocation in the monetary system somewhere down the track. Now, all of that's been parked for a while with this new crisis and pushed back for another few years. But somewhere down the track, there's a day of reckoning for negative interest rates and for the, and it probably equals inflation. That's the flip side of this. When inflation starts because of this, because money's so cheap and it inflates things and produces pricing power, when inflation becomes uncontrollable, then we got a serious economic problem.
That's 1970.
Correct. Inflation, the Western world hasn't seen hyperinflation, but you know, Zimbabwe has, and South America has, and other countries have seen hyperinflation and the damage it does when it happens. And the forces, thankfully, of disinflation at the moment are still greater than the forces of hyperinflation. So it's like this tug of war between the two.
Okay. So let me just go back up and just see where we are. So we've dealt with, should I leverage? Maybe not. We've dealt with the hybrids. We've dealt with the real issues in negative interest rates. And
Norma, one other comment, if I can, about hybrids. Yeah. And perhaps the better answer than the hybrids is bonds. You know, government bonds themselves are or corporate bonds, but government bonds will give you, a 10-year bond in Australia will give you 0.8%. Obviously, term deposits will give you 1.5%. And if inflation's not much, then it's giving you some sort of a return. So there's options. Everything in the risk curve of fixed income, you go from government guaranteed term deposits of cash and bonds out to hybrids with the higher returns and the higher risk. So there is quite a smorgasbord of choice.
Right. Let's have a look. So, of course, will a copy of this presentation be available? Absolutely. It will be posted online. What other options could we look at other than cash? We've spoken about that. Can Malcolm please comment on his thoughts re the possibility of negative interest rates and any associated issues? I think we've kind of covered that, Malcolm.
Yeah, I covered that. I mean, it's a very tricky topic. If the person who asks the question would like to call me sometime via you, Norma, then I'd be happy to go into all the implications of negative interest rates, and it's got to do with monetary systems. And you know, we'll go back to Bretton Woods in 1971 and the change in the gold standard and stuff like that, and cycle changes. And I fear there's a problem ahead in that regard.
Yeah. All right. Is there a point at which the Australian government would need to start offering bonds to normal investors?
Well, I wish they would, because so what's happening with bonds? So the government is now issuing large tranches of bonds at 0.8%. So this is the thing they're issuing. It's 10-year Commonwealth government bond at 0.83%. So they issued $14 billion in one tranche the other day. And as they issue them, most of it's being taken up by the banks because they're getting funding to on-lend to their customers. So that's one element. But when I say I wish they would, it would be good to have infrastructure bonds, an infrastructure bond for a particular purpose, which is both economically stimulatory because it's being applied to an infrastructure project, and also an infrastructure bond would typically have a higher interest rate than a non-infrastructure bond like this. So yes, that would be a good idea. The government, however, the Liberal government has got this bit of a preoccupation with balancing budgets. You know, they think of themselves as more austere. And so consequently, they're always on the lookout to reduce debt, not to increase debt. And this is one of the implications for forward thinking, is that next year or the year after, assuming that Scott Morrison and Josh Frydenberg are still at control, the Australian economy is going to be up against a government sector, a public sector that's now trying to slow things down because they want to rein in this debt. So there's a couple of interesting, again, dot joining thoughts here. One is that if you think about what's going on, the government's issuing all this hundreds of billions of dollars worth of debt. What they'll probably do is the Reserve Bank, which is currently buying everything up to 3 years, will extend their buying up to 10 years, buy the bonds, collect the coupon, the interest rate the bond pays, collect it because they'll own the bond, they'll pay for it with printed money, and they'll return the coupon to the government as a dividend. So they'll be, if you like, just recirculating the same money. And that will take a little bit of a budgetary strain off the government and allow there to be a plateauing of this debt burden after a while.
Would also kind of control inflation a little bit, I'm guessing, because of the liquidity then that will be removed out of the economy.
Yeah, the inflation one's the bogey that we're just not sure about. Well, we are sure at the moment there is no inflation. Okay, so it's the thing that spikes inflation that we need to be on the lookout for.
Right. So we've spoken about that, and then any info on owning rental properties, house and units?
It's going to depend where that question's coming from. I'm in Sydney, and the Sydney real estate market is just about to fall, right? So there's going to be a really good opportunity in real estate market in Sydney and probably Melbourne for a cyclically low opportunity in the coming years, and real estate will become a good investment subject to location, tenancies, debt, and so on. And I would have thought that it's an asset class that may be worth considering more now than it has been for a number of years. I'm aware that the Perth cycle is ahead of the East Coast cycle. So in other words, the decline happened earlier, and so the recovery is probably going to happen earlier. So it might even be that the Perth market's a better option than the Sydney market. Though just bear in mind that you can't, the stock market, my first point today was about volatility. Easiest place, the first place that gets hit when you have a crisis is the easiest, most liquid market, which is the stock market. The last place that gets hit is the most illiquid market, which is real estate. So there's going to be a problem with real estate. There's not a shadow of a doubt about that. Not everywhere, because real estate is 1,000 different markets, just like the stock market's 1,000 different stocks. Every suburb is a different market to the next. So not all markets will go badly. But generally speaking, there's going to be a problem in the real estate markets of the country. And consequently, for those that have got capacity to buy, there's opportunities ahead.
Right, so where are we now? Okay, so we've kind of answered the question about real estate again. All right, so Malcolm, I'm going to just wrap up and just say thank you to you for your calm and considered approach to investing, and for your depth of experience that you have shared with us today. And to all of our clients and participants to our webinar that have joined us, thank you so much for taking the time. And as we've mentioned earlier, the presentation will be available on our website later. And then just to wrap up and close off everything. So as an advisor, speaking to you as our clients, we have 8 steps that we would probably follow, where we are supported by somebody like Malcolm and his team with their depth of research. So for you as an individual, the things that we would be doing would be to review your risk and return profile, because each of you are unique, and each of you have a different way of thinking about what is risk and what is return and what is volatility that you can deal with on that. We would review your time horizon for investing. We would review the reason for your investment. We would review your income requirements, look at the costs of your investment vehicle, look at the tax implications of your investment strategy. We would review the cost of your insurance inside of that investment, and we would review your estate planning. So what we'd like to say is that you as an individual are what is important to me as an advisor, but behind the scenes I'm backed by depth of research and access to many professionals and experts. So if you have any questions, please don't hesitate to contact our office. My mobile is 0414 331 315 while we're working from home, and my email is norma@herebusiness.com.au. And if you have any other questions, please don't hesitate to contact me, send me an email, and we will take the next steps to answer your questions. And thank you very much, Malcolm. Much appreciated. And I'm going to wrap up. And I'll
Thank
keep
you,
you on you. We'll speak again.
Appreciate it as well.
Thank you.